JP Morgan always seems to have some of the best charts when it comes to looking at market trends. And I thought that this chart was really, really helpful for looking at the fixed income markets, particularly where we were in 2021, where we are today, and what we're looking at going forward. So this chart on the left, really quick, at the end of 2021, the 2-year treasury was paying 0.73. Today, that same 2-year treasury is paying 4.41. So in the context, if you had $1 million invested in a 2-year treasury, at the end of 2021, it was paying you $7,300. That same position today is paying you $44,000. So again, massive shift in how much income a bond investor can expect to generate because of the changes that we saw. Now, obviously, while as a fixed income investor, we'd like to see higher income, we love that we can get yield on some of these positions now. That change came at a cost of seeing our bond values go down. If you owned a 10-year treasury, you saw the value come down by roughly 16% last year. If you happen to own a 30-year treasury, you saw your value come down 33%. Now, we saw that, that's in the past, but now I want to focus over here on the right side where it looks at what we can expect going forward. So obviously, there's a fear that interest rates would keep going up. So if we're looking at this, and it's talking about assuming a parallel shift in the yield curve where every investment or every interest rate goes up or down the same amount. If we have a 5-year treasury and interest rates were now going down, let's say going up 1%. So if interest rates go from 4 all the way up to 5, you would see a total return of negative 0.5 in 2023. So again, last year we saw really negative returns because the moves were so extreme. However, now because interest rates are higher, if we see that interest rates go up on a 5-year or by 1% on the 5-year treasury, we would expect a total return of negative 0.5. However, if interest rates were to go down by 1%, we would expect that same bond to generate 8.4% of total return on the year. So again, I bring up this chart to say that because interest rates have shifted up so much, even if we were to see a 1% increase in interest rates, which I don't expect, the market I don't think anticipates that to happen, but it could happen. And if it does happen, we're not expecting any sort of pain similar to what we saw either last year. We're expecting more modest hits. So again, the return profile on our fixed income investments in 2023 is certainly a lot different than it was in 2022. And again, this is talking about interest rates going down or going up, or I should say, in this case, if interest rates go up, your total return will go down. If interest rates go down, your total return goes up. But if interest rates go nowhere, well, the 5-year treasury yield is around 4% today, and that would be our expected return. So again, the returns on fixed income are much more attractive this year than they were in previous years, and that's something to keep in mind when we're looking at allocating our investments. So I just want to bring this to your attention in case you had questions about fixed income. And if you have any questions about this or anything else, feel free to ask. Thanks. Have a great day.